What are you expecting for early 2024 after, frankly, the pretty busy and interesting markets we had at the end of last year?
It is. I mean, the end of last year, we had this ferocious rally.
Yeah.
So you really seen this dip down in yields, spreads tighten, stock market's higher. And so, many feel there's not a lot left. And for sure, a lot was squeezed out, as I guess I said. But I still think there's value, right? We're still in this higher interest rate regime. Inflation is, coming down, albeit it's going to be more volatile, not coming down at the same pace. But, we still see a lot of value in fixed income. And we actually think fixed income is still a place to be from a balanced portfolio perspective.
So corporates or government?
Well, a little bit of both. So, as you mentioned, governments are issuing a tremendous amount of debt, so they have to fund these deficits. So I do think there's value there. But, certain parts of the credit markets also have value. But it's not like universal. You just can't lay on beta, I would say. So it's very idiosyncratic and very sector driven.
But Greg, I've never seen so much tension at Treasury sales at auctions than we've had in the last year. And I don't know whether there's an underlying belief in the markets, maybe if not spoken out loud, that at some point something will go wrong because of the amount of debt the U.S. has.
The fear around the deficit is amazing. I haven't seen it in such a long time. It almost pales to what we observed in 2012 with the European debt crisis. So investors are really worried about it. But it's one of these things where it doesn't matter until it matters. And so no one really knows, which makes it quite scary. But at the same time, I do think that narrative is a little overplayed at this point. Yes, there's a tremendous amount of debt. Yes, that puts pressure on yields, all else equal, raises risk premium. But I don't think it kind of changes a lot of the underlying dynamics. I
mean, I know, and when SVB went under, there was a lot of, chatter, which was, partly because of treasuries, but also there's a lot of chatter. It's always some mortgage-backed securities. I mean, it's not as simple as that. Do you still see value in that market?
I do. I mean, what we learned last year in March with the SVB crisis was more around how the markets price in central banks.
Yes.
So it was like instantaneous, almost a 200 basis point cut. And to me, that just didn't make any sense. At the time, we had 6% inflation. Growth was really quite strong. And so I still think investors are using this outdated playbook and think that any wobble in the marketplace, central banks are going to step in. And I think there's kind of a misalignment there.
And so what does that mean for opportunities?
Well, what I think it means is that yields are likely to remain higher than what investors think. This whole, front-end move down with central banks, being much more aggressive, I also think is, overplayed. And, what we feel comfortable in fixed income is actually the yield. And so we're calling it yield is destiny. So what we think is bullish around fixed income is actually the yield itself. So it's not a capital appreciation play as much as it is, as we say, roll and carry.